Today, we're digging into something pretty interesting. How actively are these quantitative funds, the quants, actually managing money compared to, well, traditional human fund managers?
Exactly. We've got this academic paper. How active is your nominally actively managed quantitative fund? Our mission really is to impact this research. Are these quants truly active? What strategies are they using? And crucially, how does their performance stack up? Especially thinking about fees.
Right, it's a big question.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So, okay, to get into this, the researchers needed ways to measure activeness. They focused on two main things, active share, or AS, and tracking error, TE.
Okay, let's start with active share. What is that exactly?
So active share basically measures how much of fund's portfolio holdings differ from its benchmark index. Think of it like a recipe. The benchmark is the standard recipe, and active share tells you how many ingredients the fund manager changed or, how much they adjusted the amounts. The formula looks at the weight of each stock in the fund versus the index.
So a high active share means the fund manager is making really different choices, picking very different stocks compared to the index.
Precisely. It's often seen as a proxy for, genuine stock selection skill, or at least the attempt at it.
Got it. And the other measure was tracking error, TE.
Right, tracking error. This one looks at the results. It measures how much the fund's returns bounce around compared to the benchmark's returns. So it's the volatility of the difference in performance.
Okay, so less about what they hold, more about how bumpy the ride is relative to the index.
Exactly. A high tracking error often suggests the fund is making big factor bets, maybe leaning heavily into growth stocks or value or small caps, things like that, which causes its performance to diverge more volatilely from the overall market index, even if the individual stock picks aren't wildly different.
So active share for stock picks, tracking error for factor bets, or overall risk difference. Both give a picture of active management.
Yep, that's the framework.
Okay, so using these tools, what did the paper actually find about quant funds? Were they super active?
Well, here's where it gets perhaps surprising. The study found that closet indexing, funds that claim to be active but really just hug their benchmark, is actually more common among quant funds than non-quants.
Really? More common?
Yeah, significantly. By the end of 2019, something like 50%, half of the assets in the quant funds they studied were managed by these closet indexers. That compares to about 38% for the non-quant funds.
Wow, 50%. So despite the sophisticated image, a huge chunk is just mimicking the index. Did they find lower active share overall for quants too?
They did. On average, quant active share was about 5 percentage points lower than for non-quants. And even if you only look at funds labeled as active, about 35% of the assets in those active quant funds were effectively closet indexers. For non-quants, that figure was lower, around 24%.
Okay, so definitely a pattern emerging there. Less distinct stock picking overall in the quant space.
And fewer funds playing in the really high active share zone, too. Only 21% of quant assets were in funds with an active share over 80%, compared to 33% for non-quants.
The researchers also grouped the funds, didn't they? Based on both active share and tracking error.
Yes. They created 5 categories to get a bit more nuance. You had the closet indexers, low AS, low TE, then moderately active, then the interesting ones. Factor bets. These have low active share, so not many different stocks, but high tracking error, meaning they're taking big swings based on market factors.
Okay, makes sense. What else?
Then concentrated stock pickers, high AS and high TE. So they're picking different stocks and probably making factor bets or taking concentrated positions. And finally, diversified stock pickers, very high AS but lower TE. Lots of unique stock picks, but spread out enough to keep the overall tracking error down.
And where did the quant funds mostly fall? Still in the less active groups.
Mostly, yes. Just like non-quants, the biggest chunks of assets for quants were in closet indexers and moderately active. But the really active categories, concentrated and diversified stock pickers, held a smaller share for quants. Only about 6% of quant assets combined versus 10% for non-quants.
And the factor bets category.
Also smaller for quants, about 3% of assets versus 7% for non-quants. So again, it reinforces this idea that quants on the whole seem to engage in less active management, at least as measured by these metrics.
Okay, now the million-dollar question. Performance. How does this relate to returns? We often hear that for traditional managers, higher active share can lead to better performance, right?
That's the classic finding, yeah. Research like Kremers and Pedeschisto found that for non-quants, but this study found the opposite for quant funds.
The opposite. So higher active share was bad for quants.
It appears so. Higher active share was associated with poorer performance among the quant funds. Those quants in the highest active share group actually underperformed the ones in the lowest AS group by a statistically significant 1.19% per year after fees.
Wow, 1.19% worse for being more active. That completely flips the script. So for quants, trying to be a distinctive stock picker actually seemed to hurt returns in this period.
That's what the data suggests. They generally underperformed the closet indexers within the quant group and also tended to lag behind non-quant funds when they had high active share.
What about the low active share quants? Do they outperform?
Well, there were some instances where low AS quants did better than low AS non-quants, but the differences weren't statistically significant, so no clear, consistent advantage there either.
And tracking error. Those factor bets. Did they pay off for anyone?
Nope. Higher tracking error generally hurt performance for both quants and non-quants. The funds really focused on factor bets. That factor bets category we talked about showed the most significant underperformance, most value erosion across the board.
So taking big risks relative to the benchmark, whether through stock picks for quants or factor bets for anyone, just didn't seem to be rewarded during this study period. What's the overall takeaway on quant performance after fees?
The bottom line was pretty stark. After accounting for fees, quant funds tended to underperform their benchmarks across all the active management styles. Every single category.
Even the closet indexers.
Even them on average, though likely by smaller margins, but particularly the more active ones. The economic impact was quite clear. A 10% rise in active share was linked to about a 0.24% increase in net alpha for non-quants, but a 0.20% decrease for quants.
That's a huge divergence.
It is, and those diversified stock pickers among the quants. Their average annual net return was a hefty 1.64% lower than the non-quant diversified stock pickers.
Okay, so the evidence seems pretty strong that high activity didn't pay off for quants here. Why? What's the theory behind quants having lower active share and it not working well when they do try to be more active?
The paper suggests it might be about incentives, specifically investor flows. For non-quant funds, especially top performers, having a higher active share often attracts more money. Investors seem to reward that apparent conviction.
Right, they see the manager taking distinct bets and hope it pays off.
Exactly. But for quants, the study found a negative relationship, or at least not a positive one, between active share and fund flows. Higher active share didn't seem to attract investors to quant funds, and sometimes might have even deterred them.
So investors might actually not want high active share from a quant fund. Why would that be?
Well, the thinking is that investors might choose quant funds specifically for their systematic, data-driven, perhaps lower deviation approach. They might see a high active share quant fund as maybe drifting from its core strategy, maybe taking unquantified risks, which could make them nervous.
That makes a certain kind of sense. You buy a quant fund for the process, maybe not for heroic stock pick. What about fees? The common wisdom is quants are cheaper, right? Automation and all that.
Generally, yes, that holds true on average. The study found quants charged about 10 basis points less in total expenses, 9 basis points less in active fees. But, and this is a big but, that difference is driven almost entirely by the low active share funds. The quant closet indexers were significantly cheaper. Yes, around 23 basis points lower TER. However, for high active share strategies, the concentrated and diversified stock pickers, the fee differences between quants and non-quants basically disappeared. They weren't statistically significant.
So if you're looking at a highly active quant fund, you might not actually be getting a discount compared to a highly active human-managed fund. That really challenges the simple quants are cheaper narrative.
It definitely complicates it. You have to look at the type of strategy.
This all points towards some, well, potential downsides or limitations of the quant approach as seen in this study. What were the key ones highlighted?
Well, first, obviously, the apparent lack of stock-picking alpha compared to non-quants in those highest strategies. That's a big one. Second, their inability to generate value from factor betting, which, to be fair, non-quants struggled with too.
Okay, lack of stock picking edge, ineffective factor timing. What else?
There's the inherent nature of quant models. They're disciplined, rule-based, which is often a strength, but it can also mean inflexibility when something truly unexpected happens in the market, something not in the historical data the model trained on.
Right, they can't easily react to a sudden crisis or a completely novel event in the same way a human might.
Potentially. And then there's the risk of overcrowding. If many quant funds are using similar data sources and similar types of signals, maybe it just gets harder and harder for any single fund to find unique sources of alpha by deviating. The edge gets competed away.
That makes sense. Did the paper mention anything about the type of information quants use?
Yes, and it's a key point. Quants are obviously brilliant at processing enormous amounts of data, price history, volume, accounting numbers, you name it. What they might struggle with is soft information. Things like assessing the quality of a management team, understanding subtle shifts in industry dynamics, gauging brand perception, or interpreting, geopolitical whispers, stuff that's hard to quantify but that a human manager might factor in.
The qualitative side.
Exactly. And this might be partly why quants tend to have lower active share. They might naturally gravitate towards larger, well-known stocks where there's tons of readily available hard data, rather than venturing into less analyzed areas where soft information might be more crucial.
That's a really insightful point. Okay, let's try and summarize the key takeaways from this deep dive. It seems closet indexing is surprisingly widespread among quant funds.
Right. And crucially, for quants, higher active share didn't correlate with better performance during this period. It often meant worse results.
And after fees, quants generally underperformed their benchmarks across the different active strategies looked at.
Yeah, and the idea that quants are always cheaper, that's really only true for the low activity strategies. High activity quant funds charge similar fees to high activity non-quants.
Plus, it seems investors might just view quant activity differently, perhaps not rewarding high active share in the same way they do for traditional managers.
Exactly. It gives you a much more, let's say, nuanced picture of the quantitative active management landscape. It's not as simple as just algorithms versus humans.
Definitely not. So here's a final thought to leave you with. This research covers data up to 2019. We've seen an explosion in AI, machine learning, alternative data in finance since then. How might these newer, more powerful technologies be changing things?
That's the big question, isn't it? Could advanced AI be helping quants overcome some limitations, maybe getting better at processing unstructured or softer data, or developing more unique signals?
Or perhaps creating new challenges. And maybe metrics like active share and tracking error aren't even enough anymore to capture what these super sophisticated new quant strategies are really doing. What new ways might we need to evaluate their activity and their value going forward? Some real food for thought there.
Absolutely. The landscape is constantly evolving.
Well, thanks for joining us for this deep dive into the world of active quant management.